Most people believe that institutions operate on information that is roughly similar to what the public can access. They assume that when banks make major allocation decisions, they are reacting to the same headlines, the same economic releases, and the same analyst reports that everyone else reads. But this assumption misses the most important dynamic in financial markets. Institutions do not react to information, they position ahead of it. And when you see positioning that contradicts everything the public narrative is telling you, that divergence is the signal. In December 2024, while financial media was running stories about subdued precious metals demand and lackluster industrial consumption, something extraordinary happened in the warehouses of the COMEX. JPMorgan Chase moved 47 million ounces of physical silver into their eligible inventory. Their holdings jumped from 12 million ounces to nearly 60 million ounces in what represents the largest single institutional accumulation since the silver squeeze of 2011. This was not a futures position, this was not a derivative hedge, this was physical metal moved into vaults, held under their direct control. The timing of this move is what makes it significant, because while the accumulation was happening, the narrative surrounding silver was overwhelmingly bearish. Analysts were pointing to weaker manufacturing data out of China, they were highlighting elevated inventory levels, they were suggesting that industrial demand had peaked, and that prices were likely to drift lower through early 2025. The message was clear. Silver was not a priority asset. And yet, in the middle of this supposed weakness, one of the world's most sophisticated banks was executing the largest physical accumulation in over a decade. When institutions do the exact opposite of what the prevailing narrative suggests they should be doing, it is worth paying attention, because they are either catastrophically wrong, which is possible but unlikely given their access to data and expertise, or they know something that has not yet been priced into the market. And in the case of JPMorgan and silver, the evidence strongly suggests the latter. This is not speculation. This is observable behavior backed by publicly available wirehouse data that anyone can verify through the CME Group's daily stock reports. The question is not whether this accumulation happened. The question is what it tells us about what is coming. To understand why this matters, you need to understand what JPMorgan was doing in the silver market before this accumulation. For years, this bank was the primary actor in what became one of the most expensive manipulation cases in precious metals history. Traders at JPMorgan were caught engaging in spoofing, a practice where they would place large sell orders to push prices down, then cancel those orders before execution. The goal was to create the appearance of selling pressure, trigger stop losses, and buy metal at artificially depressed prices. In 2020, JPMorgan paid $920 million in fines to settle charges related to precious metals manipulation. Individual traders faced criminal prosecution. This was not a minor compliance violation, this was systematic, deliberate price suppression. The significance of this history cannot be overstated. JPMorgan was not a neutral observer in the silver market. They were actively working to keep prices low, and the reason they were working to keep prices low is because they were accumulating. When you are building a massive position in an asset, the last thing you want is for prices to rise before you finish buying. So you suppress, you create the appearance of weakness, you shake out weak hands. And then once your accumulation is complete, you stop suppressing and let the market discover the real price. What we are witnessing now is the transition from accumulation to release. JPMorgan spent years keeping silver prices contained while building their position. The 47 million ounce move in December was not the beginning of their accumulation. It was the final stage. It was the moment when they locked in their position ahead of what they know is coming. And what is coming is a regulatory and structural shift that will force the entire precious metals market to reconcile paper claims with physical reality. The catalyst for this shift is Basel III, the international banking regulation framework that went into full implementation for US banks on January 1st, 2025. The specific provision that matters here is the net stable funding ratio requirement, which fundamentally changes how banks must account for precious metals on their balance sheets. Under the old rules, banks could hold what are called unallocated metal positions. These are paper claims on metal that do not correspond to specific physical bars. Banks could sell 100 ounces of silver on paper while only holding 10 ounces of physical metal, betting that all 100 paper holders would never demand delivery simultaneously. Basel III eliminates this arrangement. If banks want to hold unallocated positions, they now face significant capital charges. They have to set aside additional reserves against that exposure because regulators have finally recognized it for what it always was: leverage risk disguised as hedging. This leaves banks with two choices. They can physically allocate the metal, holding 1 ounce of physical for every ounce of paper sold, or they can accept the capital penalties that reduce their profitability. The incentive structure is clear. Banks are going to scramble for physical metal. JPMorgan's December accumulation was not speculation, it was pre-allocation. They secured physical metal before Basel III enforcement began, before every other bank with unallocated positions started competing for the same limited supply. This is front-running at the institutional level. And the fact that they moved 47 million ounces tells you something about the scale of the allocation gap that exists across the banking system. If one bank needs 47 million ounces to cover their exposure, how much do all the banks need collectively? And where is that physical supply going to come from when industrial users are hoarding, when sovereign buyers are accumulating, and when Eastern vaults are draining Western inventories? The mathematics of this supply problem are straightforward but stark. Global silver production in 2024 came in at approximately 822 million ounces. Industrial demand, which includes everything from solar panels to electric vehicles to defense electronics, consumes 654 million ounces. That leaves a gap of 168 million ounces before you even count investment demand. When you add the roughly 200 million ounces of investment demand that occurred through coins, bars, and ETFs, you are looking at a structural deficit of 32 million ounces. Production minus total demand equals negative 32 million. This deficit gets filled by drawing down above-ground inventories, the stockpiles held in vaults, warehouses, and ETFs. But those inventories are not infinite, and they are shrinking. This is the first year since 2015 where production cannot meet industrial demand alone, before investors even enter the equation. And unlike cyclical deficits that resolve when economic activity slows, this deficit is structural. It is driven by energy transition mandates and military procurement that happens regardless of GDP growth. Governments have legislated this demand into existence through green energy requirements and defense spending bills that are not going away. On the supply side, the constraints are even more concerning. Silver is not primarily mined as a target metal. About 70% of global production comes as a byproduct of mining other metals like copper, lead, zinc, and gold. This means silver supply is not directly responsive to silver prices. A copper miner does not increase production because silver hit $70. They make decisions based on copper economics. And the silver is incidental, so even with silver prices rising, the supply response is muted because the primary metal driving the mining decision has not moved proportionally. For the 30% of production that comes from primary silver mines, expansion is slow and capital intensive. Existing mines are already operating near capacity. Adding capacity requires permitting, engineering, and construction that takes 2 to 3 years minimum. New mine development from discovery to first production typically takes 7 to 10 years. By the time new supply comes online in response to today's prices, the market conditions that justify the investment may have completely changed. This is why mining supply is inherently sticky and cannot react quickly to demand shocks. What this means is that relief from the supply side is not coming soon, and JPMorgan knows this. They have access to production forecasts that show the deficit widening in 2025 and 2026, not improving. They see industrial demand accelerating as solar installations ramp up and EV manufacturing expands. They see Eastern accumulation continuing as de-dollarization drives sovereign buyers toward hard assets. And they see a paper market built on leverage ratios that cannot survive when physical delivery demands increase. The COMEX currently has roughly 250 paper ounces traded for every physical ounce in registered inventory. That leverage ratio has more than doubled since 2011, while physical supply has gotten tighter. If even a small percentage of paper holders demand physical delivery, say 10% instead of the normal 3 to 5%, the system breaks. There simply is not enough metal to honor those contracts. The exchange would face a choice between defaulting on delivery, changing rules to force cash settlement, or letting prices run to whatever level brings physical supply back to market. We are already seeing stress in the delivery system. The December 2024 COMEX contract saw 18% delivery request, which is 3 to 4 times the historical average. Elevated delivery requests mean traders do not trust the paper price. They want actual metal because they believe physical is worth more than futures are indicating. JPMorgan sees this data in real time. They see the delivery pressures building. They see other banks starting to position. That is why they moved 47 million ounces in December rather than waiting to see how things develop. The comparison to what JPMorgan did with gold from 2018 to 2020 is instructive. During that period, they quietly accumulated massive physical gold positions that were reported in quarterly filings, but largely ignored by mainstream financial media. Gold was trading around $1,200 per ounce when they started buying. By August 2020, gold had reached $2,070. They positioned ahead of the monetary expansion and inflation that everyone now acknowledges happened. They knew what was coming because they have relationships with Federal Reserve officials and access to intelligence about policy directions before those policies are publicly announced. They are following the exact same playbook with silver now. Accumulate physical metal while prices are suppressed by a bearish narrative, position ahead of regulatory changes that will force allocation, and then step back and let the market reprice the asset once the supply constraints become undeniable. The difference between gold in 2018 and silver in 2024 is that the supply deficit in silver is more acute, the leverage in the paper market is higher, and the industrial demand component creates additional pressure that gold does not face. What makes this setup even more compelling is what is happening on the sovereign level. In December 2024, China's State Administration of Foreign Exchange disclosed $8.2 billion in precious metals purchases during the fourth quarter. That represents a 340% increase from the third quarter. At an average silver price of $32 per ounce, this could represent over 250 million ounces of silver purchases. And this happened during the same quarter that China reduced their US Treasury holdings by $53 billion. This is not portfolio rebalancing. This is a coordinated rotation out of dollar-denominated paper assets and into physical hard assets. When you see a sovereign nation making this kind of allocation, they are not speculating on commodity price movements. They are preparing for a monetary system change. They are reducing exposure to assets that carry counterparty risk and increasing exposure to assets that exist outside the framework of any single currency or financial system. Gold and silver become insurance against the possibility that the dollar-based reserve system fractures or that inflation erodes the real value of fixed income holdings. The timing here is not coincidental. China's $8.2 billion disclosure came just days after JPMorgan completed their 47 million-ounce move. Basel III implementation began 2 weeks later on January 1st, and the largest COMEX silver futures contract since 2020 expires on March 28, 2025. These events are converging in a 3-month window that creates a perfect storm of physical demand hitting a market that is already structurally short. Every institution that needs to allocate for Basel III compliance, every sovereign buyer securing strategic reserves, and every industrial user hoarding ahead of supply tightness will be competing for limited physical inventory at the same time. The behavior in the ETF market is another signal that something fundamental is shifting. The SLV Silver ETF, the largest silver fund in the world, saw net outflows of 22 million ounces in November and December 2024. That represents institutional and retail investors selling their paper silver exposure. Under normal market conditions, 22 million ounces of selling pressure should cause prices to decline. Basic supply and demand mechanics would suggest that when sellers exceed buyers, price falls. But prices stayed stable between $30 and $32 throughout this entire period. This divergence tells you that someone was absorbing every ounce being sold without pushing price down, and the only entities capable of absorbing that volume without impacting price are large institutional buyers who are accumulating for strategic reasons rather than trading for profit. These buyers do not care about short-term price fluctuations. They are positioning for much higher prices ahead and view current levels as an opportunity to build positions before the broader market catches up. The fact that prices held firm despite massive ETF outflows is technical proof that physical silver is being accumulated by informed buyers while paper sellers, the uninformed money, are exiting their positions. What this also reveals is a flight from custodial risk. Sophisticated investors are selling ETF shares, which are claims on silver, and buying physical metal directly. They are reducing counterparty risk ahead of a potential crisis where paper claims might not be convertible to physical delivery. They saw what happened in March 2020 when gold and silver premiums exploded and ETFs struggled to source metal to meet redemptions. They saw the temporary disconnect between paper and physical prices, and they are ensuring they do not get caught on the wrong side of that divide when it happens again. The Vault data confirms this reallocation from west to east. The London Bullion Market Association reported total silver holdings of 959 million ounces in December 2024. That represents a decline of 4.2% from January 2024. Western vaults are bleeding physical metal. Meanwhile, the Shanghai Gold Exchange, China's physical metals exchange, saw silver withdrawals of 1,240 tons in November 2024 alone. That is the highest monthly withdrawal figure since the SGE began keeping records in 2008. You are witnessing a geographic rebalancing of physical silver from countries that treat it as a commodity to countries that treat it as strategic wealth. From economies running massive trade deficits to economies running trade surpluses. From dollar-dependent financial systems to nations building alternatives to dollar dominance. This is not temporary capital flow that reverses with interest rate changes. This is structural reallocation driven by geopolitical fragmentation and monetary system evolution. The silver leaving Western vaults is not coming back. It is being accumulated by entities that view it as permanent reserves rather than trading inventory. When you combine the supply deficit, the regulatory catalyst, the institutional positioning, and the sovereign accumulation, what you get is a market that is mathematically set up for significantly higher prices. The question is not whether prices will rise. The mathematics make that virtually certain. The question is how much and how fast. And to answer that, you need to look at what happened in previous silver squeezes and understand the mechanisms that drive price discovery when physical shortages meet paper market leverage. In 2011, silver went from $26 to $49 in 4 months. The catalyst was a combination of physical shortage meeting paper leverage. The COMEX had sold far more silver on paper than they could deliver in physical form. When delivery demand spiked, the exchange could not meet them and prices exploded. The rally ended when the exchange intervened by raising margin requirements, dramatically making it prohibitively expensive to hold long positions. But that intervention came after prices had already doubled. And the setup today is more explosive than it was in 2011 because the leverage in the paper market is higher, the supply deficit is larger, and you have sovereign buyers rather than just hedge funds and retail investors. The gold to silver ratio provides another framework for understanding where prices could go. Historically, this ratio has averaged around 60 to 1, meaning 1 ounce of gold equals 60 ounces of silver. Currently, the ratio sits around 82 to 1, with gold trading near $2,650 and silver at $32. If the ratio compresses to its historical norm of 60 to 1 and gold holds at current levels, silver is simple math, puts silver at $44. If gold rises to $3,000, as many analysts expect, given continued central bank buying and inflation concerns, then 60 to 1 puts silver at $50. But the ratio does not compress gradually when you have a supply squeeze. It happens violently. In 2011, the ratio dropped from 65 to 1 to 31 to 1 in 4 months. In 2020, it went from 120 to 1 to 65 to 1 in 3 months. When physical shortages meet paper market leverage, the ratio does not compress linearly, it crashes. And when it crashes from 82 toward 60, with gold at 2,650, sentiment turning positive, institutional money flowing in, Basel III forcing allocation, China buying, and industrial users hoarding, the math says silver blows through $50 and tests 100 before equilibrium is found. $100 per ounce is not a speculative target. It is what happens when you run the numbers on institutional discovery of a small market. Global institutional portfolios manage approximately $121 trillion. If just 5% of institutions decide to allocate 1% of their portfolios to physical silver as a monetary hedge, that is $60 billion in potential demand. The total global above-ground investment silver stock is worth approximately $30 billion at current prices. You have $60 billion in demand chasing $30 billion in supply, which would require prices to double just to reach equilibrium, and that assumes all current investment silver is available for sale, which it is not. Much of it is held by long-term investors who are not selling, much is tied up in ETFs with redemption restrictions, and much has moved east and is not coming back to Western markets. So $64 becomes the floor, not the ceiling, in a scenario where institutions simply wake up to what JPMorgan and China already know. And we have not even factored in the supply deficit or the paper market leverage in that calculation. When you add those components, $100 becomes the logical destination rather than an optimistic outlier. The comparison to the Hunt brothers episode in 1979 and 1980 is worth examining, not because the situations are identical, but because the leverage dynamics in the silver market have not fundamentally changed. The Hunt brothers accumulated approximately 100 million ounces of silver, which represented about 6 6.5% of annual global production at the time, over 18 months, silver went from $6 to $50, an 8.3 times price increase from a group controlling just 6.5% of production. China's disclosed purchases in the fourth quarter of 2024 potentially represent 250 million ounces, which is 30% of annual production, not 6.5%. If we apply the Hunt brothers' mathematical framework, the historical precedent would suggest prices could spike significantly higher than $50. Now, sovereign accumulation is different from speculative cornering. China is not trying to manipulate markets in the way the Hunts were. They are building strategic reserves for long-term national interests. But the math shows you the leverage that exists in the silver market when large entities accumulate meaningful percentages of supply. The market is that small and that responsive to concentrated buying, and when you have multiple large entities accumulating simultaneously, JPMorgan with 47 million ounces, China with potentially 250 million, other sovereign buyers whose purchases are not publicly disclosed, industrial users hoarding ahead of supply tightness, the cumulative impact on available supply is enormous. The pool of metal available to commercial buyers shrinks rapidly, and price is the only mechanism to ration scarcity. The timeline for this repricing is what makes the current moment particularly interesting. Basel III reinforcement began on January 1st. Banks that were running unallocated positions now face capital charges unless they physically allocate. This creates the first wave of institutional buying pressure in January and February as banks scramble to secure metal. Then you hit late January and early February with Chinese New Year, which historically triggers a surge in Asian physical buying due to cultural traditions around gifting gold and silver during lunar celebrations. Eastern buying accelerates right as Western banks are trying to source physical for regulatory compliance. And then comes March 28th, the expiry for the largest COMEX silver futures contract since 2020. As of late December, open interest stood at 127 million ounces. If even 15 to 20% of those contracts stand for delivery, and remember, December saw 18% delivery requests, that is 19 to 25 million ounces of physical demand hitting an exchange that currently has only about 30 million ounces of registered inventory. The math does not work. COMEX cannot deliver 25 million ounces when they only have 30 million available, and banks are simultaneously draining inventory for Basel III compliance. Something has to give. Either prices spike to bring supply to market, which means significantly higher prices than current levels, or the exchange changes the rules to prevent default. And if they change the rules, if they force cash settlement or implement emergency position limits, that destroys paper market credibility. Traders realize the exchange cannot deliver physical metal when pushed. When that credibility breaks, everyone holding paper or silver tries to convert to physical simultaneously, ETF redemptions spike, premiums over spot explode, and you get the kind of violent repricing that happened in March 2020, except this time it would not be temporary dislocation caused by pandemic panic, it would be structural shortage meeting paper market collapse. April through June adds another layer of pressure because that is peak solar season. Spring and early summer is when solar panel installation ramps up in the northern hemisphere. If silver inventories are already tight from institutional buying and COMEX stress, industrial users start panic buying. Solar manufacturers who need guaranteed supply start paying premiums to lock in delivery. Automakers building EV charging infrastructure compete for available metal. When industrial users who absolutely need silver for production compete with investors for limited supply, prices do not gradually adjust. They gap higher. You see $5 to $10 daily moves as spot shortages emerge in manufacturing hubs. The convergence of these catalysts between January and June 2025 is remarkable. You have regulatory enforcement, Eastern buying season, major contract expiry, and industrial demand all hitting in a 6-month window. Any one of these would create upward pressure. All of them together create the conditions for an explosive repricing, and JPMorgan positioned ahead of all of it by moving 47 million ounces in. That is not a coincidence. That is an institution with access to the best information in the precious metals market, securing their allocation before the stampede begins. The difference between paper exposure and physical possession becomes critical in this environment. ETFs like SLV are convenient and liquid during normal times, but they carry counterparty risk. You own a claim on silver, not actual silver. If physical supply gets tight enough that the fund cannot meet redemptions, they can freeze withdrawals, move to cash settlement, or implement restrictions. The fund prospectus explicitly allows for this. Physical silver that you possess directly or store in allocated storage where specific bars are assigned to you eliminates that counterparty risk. You own metal, not a promise to deliver metal. In a scenario where paper and physical markets disconnect, physical holders capture the full premium while paper holders get whatever settlement the fund decides to offer. This is why premiums on physical silver are already elevated and why those premiums expand during stress. The premium is the market pricing in the risk that paper claims might not be convertible to physical delivery. When you see premiums expanding from $3 over spot to $10 or $15 over spot, that is not dealers being greedy. That is the market recognizing that paper and physical are no longer the same thing. The institutional money understands this, which is why we saw 22 million ounces flow out of SLV while prices stayed stable. They are reducing counterparty risk before the crisis, not scrambling during the crisis when premiums are $20 or $30 over spot. This is the same lesson that gold investors learned in March 2020 when physical gold premiums spiked to $100 over spot because no one could source metal at the paper price. The paper market said gold was worth $1,700, but you could not buy an ounce for less than $1,800. The divergence lasted for weeks until futures prices finally caught up to physical reality. What is happening in silver now is the early stage of that same dynamic, except the structural drivers are stronger and the regulatory catalyst is forcing institutional participation. This is not a temporary dislocation that resolves when sentiment normalizes. This is a permanent repricing driven by supply constraints that are not going away. Industrial demand is legislated into existence through energy mandates. Sovereign accumulation is driven by monetary system concerns that are intensifying, not dissipating. And Basel III enforcement is permanent regulation, not temporary intervention. JPMorgan's 47 million ounce move is the clearest signal we have that this repricing is coming and that the timeline is measured in months, not years. They do not make accumulations of this magnitude for marginal returns. They are not trying to earn 5 or 10%. They are positioning for a doubling or tripling minimum. They have done this before with gold. They waited patiently while accumulating, let the regulatory and market forces play out, and captured enormous gains when prices finally adjusted to reality. They are following the same playbook with silver, and the setup is even more explosive than it was with gold. The question is not whether silver is going to $100. The mathematics of supply deficits, institutional discovery, and paper market leverage make significantly higher prices virtually certain. The question is whether you position ahead of that repricing or whether you wait for confirmation that only comes after prices have already moved. JPMorgan did not wait for confirmation. They positioned in December at $32. Pana did not wait for confirmation. They bought aggressively in the fourth quarter while prices were range-bound. These are not entities that chase rallies. They create them by positioning ahead of structural shifts that the market has not yet priced in. The window to position alongside these institutions is narrowing. Basel III enforcement has started. The March contract expiry is less than 3 months away. Whatever institutional buying has not happened yet will happen in the next 90 days because after March, the price will be higher and physical supply will be tighter. This is not about predicting the future. This is about watching the largest and most sophisticated players in the market show you exactly where they are positioning and understanding that they have access to information and analysis that far exceeds what is available to the general public. The recycling narrative is another element that deserves examination because it is often cited as the relief valve that will prevent prices from spiking. The logic goes that when silver prices rise significantly, more recycling will kick in as people and businesses find it economically viable to recover silver from old electronics, photographic materials, and industrial scrap. And while this is true in theory, the practical reality is far more constrained than most people realize. Recycling is not a tap you can turn on when prices rise. It is a complex, fragmented process with significant economic and logistical barriers. First, not all silver use is recoverable. Silver in many industrial applications is used in such small quantities or in such dispersed forms that recovering it is not economically viable even at elevated prices. This is called dissipative use and it represents a significant portion of annual consumption. Silver brazing alloys, silver-based catalysts in chemical production, silver used in water purification, these applications scatter the metal in ways that make collection and recovery more expensive than the value of the recovered silver. That metal is effectively lost to the market permanently. Second, the infrastructure to recycle silver is limited and concentrated in certain regions. Recycling facilities have fixed capacity. When scrap supply surges because prices have risen, these facilities face the same bottleneck issues that refiners face. They can only process so much material at a time. Backlogs develop. The silver that could theoretically be recovered sits waiting in warehouses. And building new recycling capacity takes time and capital investment. It does not happen overnight in response to price signals. Third, recycling responds to price with a significant lag. It takes time for higher prices to filter through to the individuals and businesses holding scrap silver. It takes time for them to recognize the value, gather the material, find the buyer, and complete the transaction. And it takes time for that material to be processed back into usable form. By the time recycled silver starts flowing back into the market in meaningful quantities, the acute phase of the shortage may have already pushed prices to levels that seem unthinkable today. Recycling smooths out supply over long periods, but it cannot address sudden shortages. It is a trailing response, not a leading solution. The substitution question follows a similar pattern. When silver becomes scarce and expensive, industries naturally start looking for alternatives. And in some applications, substitution is possible. Copper can replace silver in certain electrical connections, though with reduced conductivity and performance. Aluminum can replace silver in some solar panel designs, though with lower efficiency. But these substitutions come with trade-offs that companies accept reluctantly, not eagerly. They reduce product quality or increase manufacturing costs in other ways. More importantly, substitution takes time. Even when a viable alternative exists, implementing it requires redesigning products, retooling manufacturing lines, requalifying the new design with customers and regulators, and working through existing inventory of silver components. For complex products like medical devices, defense systems, or automotive electronics, this process can take years. And during that entire time, companies still need silver to maintain current production. They cannot simply flip a switch and start using something else tomorrow. What this means is that substitution does not relieve demand pressure in the short to medium term. Companies are locked into their current silver requirements by existing product designs and manufacturing processes. Even if they are actively working on substitution strategies for the future, they still need to secure silver supply today. And that need is part of what drives the panic buying we are seeing in off-market procurement. Industrial users are not just buying for current production. They are buying to ensure they have supply while they figure out how to need less silver in future product generations. The strategic dimension of industrial demand also cannot be ignored. Companies that successfully substitute away from silver reduce their exposure to future supply risk, but they also reduce their influence over the silver market. If every major industrial user substituted away over time, the market would shrink and potentially become less liquid and more volatile. This creates a collective action problem where what is rational for each individual company might be destabilizing for the market as a whole, and it means that even as some substitution occurs at the margins, core industrial demand remains sticky and price inelastic. The geopolitical overlay on all of this adds another dimension that is increasingly difficult to ignore. Silver is not just a financial asset or an industrial input, it is increasingly recognized as a strategic resource. It is essential for defense technology, renewable energy infrastructure, and advanced electronics manufacturing. Countries that want technological and military independence need secure access to silver, and in a world that is fragmenting along geopolitical lines, that access becomes a matter of national security rather than commercial procurement. This is why sovereign accumulation is accelerating in ways that go beyond simple portfolio diversification. When China discloses $8.2 billion in precious metals purchases, and simultaneously reduces treasury holdings by $53 billion, that is not about expected returns on investment. That is about reducing dependence on dollar-denominated assets and building reserves of tangible resources that cannot be sanctioned, frozen, or inflated away by another country's central bank. Silver serves this purpose alongside gold, particularly given its industrial applications in military and technology sectors. The problem this creates for commercial markets is that sovereign buyers do not operate like commercial buyers. They do not sell when prices get high to lock in profits. They do not care about maximizing returns over quarterly reporting periods. They care about securing multi-decade supply for strategic needs that may not even exist yet, but could become critical in future conflicts or economic disruptions. When a government decides to accumulate silver as a strategic reserve, they remove that metal from commercial circulation permanently. It sits in a vault, off limits to the market, waiting for a future that may or may not require it. This means the visible supply, the metal available for commercial trade, is shrinking faster than production statistics suggest. Official data shows annual production and consumption as relatively balanced, with modest deficits. But those statistics do not capture the metal disappearing into sovereign reserves through off-market transactions. They do not show the strategic stockpiling happening behind closed doors, and they do not account for the permanent removal of metal from commercial circulation when it crosses into government hands. As geopolitical tensions continue to increase, this dynamic will only intensify. More countries will decide they need strategic silver reserves, more sovereign buyers will enter the market, and the pool of metal available to commercial buyers will continue to shrink. This is not a short-term phenomenon that resolves when tensions ease. Once a country builds a strategic stockpile, they maintain it. The metal is effectively removed from global supply on a permanent basis. And that structural reduction in available supply is part of why the current shortage feels different from past cyclical tightness. The way this all connects back to JPMorgan's 47-million-ounce move is that sophisticated institutions understand these dynamics better than anyone. They see the supply deficit, they see the structural demand from industry and sovereigns, they see the paper market leverage, they see the regulatory catalyst, and they see a timeline where all of these forces converge in a compressed window. That is why they positioned in December rather than waiting to see how things develop. They are not making a bet. They are responding to certainty. When the house stops running the casino and starts betting with the players, the game is ending. JPMorgan was the house for years, manipulating prices downward while building their position. Now they are betting with you. Now they are long physical silver going into a regulatory and supply environment that favors massive repricing. That is the signal. That is what 47 million ounces in December is telling you. The only question is whether you believe the signal strongly enough to act on it before the broader market catches up and prices adjust to reflect the reality that institutions already understand.